Morning, everyone, and thank you very much for joining. Um, this is the morning market review. My name is Russell Shaw. It's Tuesday, it's the 14th of March, and my email address rshaw@fxcm.com. Can I just double check that you guys can hear me, see the screen, and see me? Just want to double check here. Okay. Excellent. All right, let's just go ahead and bring up our disclaimers. Here's the high risk investment warning. And here is our market commentaries disclaimer. I'm using two monitors, so if I'm not looking directly, I apologize. I'm just trying to monitor both monitors, so to speak. And here is our references, market scope, and trading view. I want to revisit the US dollar Canadian because this is something that we spoke about last week, and it's changed. What we did last week is we actually looked at a potential uptrend in the US dollar 2-year and the Canadian 2-year notes. You can see that's collapsed. So what we're trying to do is we're trying to marry the relative strength with the relative weakness and then see if we can potentially use that to our advantage. But of course, with the banking crisis or the crisis in confidence in the US banking sector, the 2 years come down. So we're going to have to pay particular attention to how this evolves, but effectively the advantage that the US dollar had over the Canadian in terms of the central bank hawkishness has dissipated. And because that's dissipated, it's worth just revisiting that and making sure that we understand that it's no longer in force. So that's the first thing on my agenda, just the US dollar Canadian. If there's any questions around that, please go ahead and type those in. But the actual fundamental picture here has changed. Now, another picture that is in development is the US dollar. I want to do a top-down analysis here. This is very speculative, what I'm going to propose to you, but watch the labeling that we're going to put in here. So we'll put in the left shoulder over here. We'll put in the head over here. And we'll put in the right shoulder question mark here. So I don't know if we're getting a right shoulder here, but it looks very interesting. And we'll just have to see if it reaches the neckline here, and if it crosses below, then we've got a serious topping pattern over here. And this is just something I saw the other day, and it's very, very interesting. If we take a look, say, at the euro US dollar, so we've got this topping pattern on the US dollar. If we take a look at the euro US dollar, we should see an inverse to that. So let's just bring that up. Okay, and well, we don't quite have the bottom, but we've got a V reversal, right? So the euro showing some signs of strength, just as that US dollar showing signs of a potential topping pattern. I want to keep an eye on that. Let's just go back to the trading view, and I want to show you what's potentially happening here. We haven't looked at the yield curve for a long time, so I'm just going to go the US 10-year minus the US 2-year. And it's been quite severely inverted for quite some time. Let's just make this a weekly chart. And you can see here is the zero line. And effectively what this is telling us is that when we subtract the 2-year from the 10-year, the 2-year is actually got a higher yield, making this an inverted yield curve. It looks like it's starting to normalize. Now, that would be quite something if we do get it, because the normalization is really from a credit event, isn't it? It's not from sort of a macroeconomic disinflation type of event. This is a credit event, and that credit event now seems to be suggesting that the Fed hiking cycle might be coming to a apex a lot sooner than we expected. Now, the news is changing daily. What we're saying here is highly speculative. We're going to get the CPI, I beg your pardon, we're going to get the CPI, the US CPI today at 2:30 p.m. ZA. That's going to be 12:30 p.m. UK. That's because the US changed their clocks over the weekend, so we're getting it an hour early. And we want to see what's happening with the inflation. Now, the inflation has been sticky, but now we've got this added banking confidence crisis, and this maybe starting to suggest a normalization, a re-steepening of the yield curve. Well, what does a re-steepening of the yield curve means? It means that the 2-year is starting to come down relative to the 10-year, and if that's the case, then we are closer to the apex in that hiking cycle than we are than we've previously much closer to the apex than we previously thought. So just to reiterate, we've looked at the US dollar Canadian, we've looked at the US dollar, we've gotten this strange kind of head and shoulders top. We're just going to see if the right shoulder actually evolves on that US dollar. That would only make sense. It would only make sense if we're coming closer to the end of the hiking cycle. And lo and behold, we may even, dare I say, get rate cuts. Again, very speculative. We're missing a gigantic piece of the puzzle. What's that piece of the puzzle? It's inflation. All right. I want to just take a look at the 2 more charts. The first chart I want to take a look at is the US banks. I'm going to take a look at the US banks basket. So this is an FXCM basket, and something has happened here, which is severe. What's happened? Well, we've had a higher trough and we've had a higher peak. Okay, this higher trough and a higher peak, and that now is no longer the case. In fact, we've got a lower trough here. In other words, the banking sector has stopped moving in that uptrend. An uptrend is defined by peaks and troughs, and the fact of the matter is we've got this lower trough. If I have to really be strict about this, and this is where it gets quite sort of scary, is that well, let's take this out and let's zoom in just to this part over here and take a look at, if I have to be very strict, I can put in a peak over here. Let's just see if this is a trough. Let's see here, the low is 2947.80, the low here is 2937. Okay, no, that's okay. So we've got a peak and we've got a trough. So we don't have a downtrend yet in the US banks, okay, but we don't have an uptrend anymore, and that is really it's a completely noteworthy. Why is it completely noteworthy? It's completely noteworthy because when you are in a hiking environment, often money would find its way through to the US banks, and the reason it will go through to the US banks is because there is a margin play over here. In other words, the higher interest rates theoretically should benefit the US banks. All of a sudden, we're seeing now a couple of things, several things that suggest that the rate hiking cycle is perhaps much closer to ending than we thought just a week ago. Number one, okay, is that the US dollar has that topping pattern. Number two, the inverted yield curve seems to be normalizing, seems to be steepening. Number three, the US banks is no longer trending up. Well, how can it not be trending up if we're in a rate hiking cycle? What is the mechanism for the rising rates? Rising rates, well, we've seen rising rates basically because they are looking to control inflation, aren't they? But now what they're trying to do is they're trying to make sure that they don't tighten too much because there's effectively a liquidity crisis going on. So they can't take much liquidity out of the economy anymore, can they, Anna? Okay. So the idea here is, yeah, so what they're doing is they're trying to loosen up conditions. They've given a $25 billion backing. They're making loans available to the US banks. Loans, they're making liquidity available. You can't add liquidity and take liquidity out of the economy at the same time. And if you're raising interest rates, you're taking liquidity out of the economy. That's not what they want to do. They want to make sure that there's that backstop, so there's no fire sales of assets to cover any sort of liquidity shortages. Okay, so this is a chart of this is an FXCM basket of US banks. It's got JP Morgan in here, it's got Wells Fargo, I think it's got Citibank in here, it's got a few others, and the idea is you can see that we're no longer moving up, right? We've got a peak and a trough. Anna, does that answer your question? You can't add liquidity and you can't take liquidity out at the same time, right? Yeah, this is because of what happened to SVB. You can see that the banks have really just been absolutely hammered. And again, I want to make this case here. We don't have an uptrend anymore. We've lost the uptrend. We've lost the uptrend because this is now a lower trough. This is a lower trough. Here is the previous trough. Now think about it. Let's bring up our Microsoft Paint. Remember, in an interest rate environment, you're steepening the bank's yield curve. Okay, you're steepening the bank's yield curve. This is what it will pay deposits, and this is what it will charge on its loans. And this is the banking spread. Sorry. This is its banking spread. So this is profit. So you want to invest in banks in a rising yield environment to take advantage of the steepening yield curve. But the idea now is we don't have that uptrend anymore. We've lost that uptrend. Well, if we've lost that uptrend, okay, what is that telling us about the hiking environment? It's telling us that that hiking environment is very uncertain at the moment. Will not the big banks benefit from inflows from other banks? Just flesh that out for me, Gurdeep. Flesh that out for me. Would the big banks benefit from the inflows? In other words, are they taking over are you talking about sort of HSBC taking over the UK branch of SVP? The interest rates are coming down because liquidity made available to banks in order to stabilize the situation. Have I got that right? But the rates came down before that. No, the rates were going up, Anna. The rates were coming up. They were going up quite drastically. Let's just take a look at that. Last week, okay, so the best way for us to take a look at this is with the 2-year yield. So in the span of a week, we've lost almost, I think, a full percentage point here. Last week, we had a high of over 5%. We're now under 4%, okay, on the US 2-year yield, okay? So the rates have come down. Yeah, the rates have come down, and the bad news about SVB, exactly. They started discounting. Remember, markets are forward-looking. They start anticipating and start expectation theory, and that's exactly what's happened, because the markets anticipated the fallout from the SVB crisis. All right. As well as others worrying over contagion, pulling money out, going into bonds, into big banks. Sorry, Gertie, just flesh it out for me a bit more. As well as others worrying over contagion. So yes, there's worries over contagion. So that's what we've seen in this chart here. We've seen it come down. We've seen the US banks, okay, lose its uptrend, and it's not just lost its uptrend. It's lost its uptrend in one fell swoop. Take a look at this. It lost it in one fell swoop. Boom. In a matter of 2 candles. Boom. It lost its uptrend. The repricing here has been absolutely vicious. It's been a vicious repricing. Last week, let's just understand what happened over the the course of a week. Last week we were thinking about a 50 basis point hike. Okay, we're thinking about a 50 basis point hike. Now, the chances of having a rate hike are much lower. In fact, I read a report that I think it's Nomura is calling for a rate cut. I don't think we can get a rate cut, but Nomura is calling for a rate cut. That's a huge change up in less than a week. In less than a week, okay. The Fed controls. The Fed action is reflected in the short end of the yield curve, and so the market, there's been a disconnect between the market and the Fed for a long time, and then it kind of came together. Did you hear that in the news? In that the market was thinking that the markets are going to we're thinking of cutting rates towards the end of the year. The Fed was saying there's no ways we're going to cut rates towards the end of the year. There was been a disconnect. So the markets and the Fed have this fusion. They work together. Sometimes there's a disconnect, but they always come back together. They kind of move together and apart, but they tend to move in exactly the same direction. Just timing may be a little off. Okay. It was rumored it's going to go up again this year. Yeah, but it's changed in about a week. That's what we're saying here. You know, in about a week, we've seen the, let's just go back here. We've seen the 2-year yield drop a full percentage point. This is crazy. Come down. It's dropped a full percentage point down. Okay. In other words, this SVB crisis now has really turned the markets on its head. We've done a 180 here. So the markets are very, very complex. Now, what's the next piece in the puzzle? The next piece in the puzzle is inflation. Inflation comes out today. Now, what would happen, just to throw the extra variable out there, what happens if inflation comes in stickier than expected, and we've got this confidence crisis going on in the US banking sector? Well, that makes being a policymaker exceptionally difficult. And that's the environment we are, that we are currently in. And I must tell you, this is probably the hardest environment I've seen for a long, long time. It is an incredibly difficult environment. I was just saying to Nick yesterday, we're changing on a daily basis. On a daily basis, there is different news. Today is going to be a whole new theme after we get the inflation number come out. I wrote the newsletter on Friday. I'm changing it today because what I wrote on Friday is no longer valid for what I wrote. What I'm going to write today is changing on a daily basis. Yeah. So the markets are very, very tough. All right. I just want to go through what we've done. We went through the US dollar Canadian. So last week we were talking about a relative strength versus a relative weakness. That's out the window. We looked at the US dollar. The US dollar looks like it's got a topping pattern coming. That can only be possible if the rate hiking cycle is coming to close. Well, we took a look at the yield curve. The yield curve looks like it's steepening. It's starting to normalize. Well, that can only happen if the rate hiking cycle is coming to an end. Then we took a look at the US bank sector. The US bank sector has lost its uptrend. Well, how is that possible if we're still in a rate hiking cycle? We're in a very strange, very difficult market indeed, and this is what we've got to wrestle with. Any questions? I know that we've dealt with a fairly complex topics this morning, but it is a very complex situation that we're in. Any questions? All right. Anna writes yes. All right. She's just trying to formulate it. Any other questions just whilst we're waiting for the question? I just want to reiterate, guys, it's a very, very tough market out there. That means that you've got to use stop losses and you've got to use money management. Absolutely have to. Couldn't the rates just start going up again? Well, Anna, what we've got here is effectively two opposing forces. It really comes down to which is going to be the stronger opposing force. The fight to control inflation, or the fact that we have this credit event that's taken place. They're moving in opposite directions. So no, interest rates can't just start going up again. Not if the banking crisis overwhelms. And the banking crisis also will have knock-on effects. It will have flow-on effects within the macroeconomy. That in of itself may help, in a strange sort of way, some of the demand issues that we're having. The variables at play this week are completely different to the variables that we had last week. And that's the magic of the financial markets. The financial markets are dynamic, constantly changing. And the puzzle of actually trying to analyze the financial markets is very challenging. That's what it takes. It takes really concentration and thought. And even then, it's very difficult to pass out what's going on in the current market environment. Current market environment is very, very difficult indeed. Tightening of credit. Yeah, exactly. So there might be some sort of disinflationary offshoots from this. Exactly right. The SVB was a very specific kind of bank, not funded like ordinary big banks. That's true. It's probably was an outlier, but there are a lot of banks out there that are holding losses on their bond portfolios. Regardless, the SVB was probably an outlier, but the fact of the matter is that the markets are worried, and they'll be worried for a reason. So I think Citibank's got over 100 billion in losses on its bond portfolio. So there is some stress out there. All right. I think that's where we'll leave it for this morning. Very challenging. We'll try to visit it again tomorrow. We'll try to pass it out again tomorrow. Tomorrow, we do have the crypto minute as well. All right, guys. I read that, Gurdeep. I don't have an answer for you. All right, guys. Let's wrap up here, and we shall speak tomorrow. Have a good day and a good evening ahead.